Hi students, welcome to the video on Management Accounting Ratio Analysis. We have already taken two videos on ratio analysis. In this video, we will solve one problem relating to liquidity ratios. So, ratios are classified under two heads. One is traditional classification, another functional classification. On the basis of financial statement to which the determinants of ratio belong are traditional classification. That means on the basis of financial statement, that means all variable belongs to income statement. Suppose we will calculate the gross profit ratio, that is gross profit divided sales. Both the variable belongs to profit and loss statement. Then suppose we will calculate on the basis of balance sheet. Suppose we will calculate current ratio, that is current assets by current liability. Both the variable belongs to balance sheet. Then another is composite or mixed, that means one from income statement and another from balance sheet. That is, suppose stock turnover ratio. Closing stock belongs to balance sheet and turnover sales belongs to income statement. But in functional classification, it is based on the purpose for which a ratio is computed and which is the most commonly used classification. In banks, we are following the functional classification for analyzing the ratios, that is financial ratios submitted by prospective borrowers or existing borrowers. Then, on the basis of functional classification, the ratio may be liquidity ratio, solvency ratio, activity or turnover ratio, then profitability ratios. So, we will now discuss on liquidity ratio, means which is liquid, which will meet the short-term obligation or current obligation out of its liquid assets. Liquid assets are current assets and short-term liabilities means all current liability which is repayable within a period of 1 year. Then under liquidity ratio, it is subdivided under three heads. One is current ratio, another liquid or quick ratio, third one is absolute liquidity ratio. Under current ratio, we will take current assets divided by current liability, and the ideal ratio or rule of thumb is 2:1. That means current asset is twice of current liability. So we should first know or understand the liquidity ratio. What is healthy current ratio? So business with healthy current ratio can meet its short-term demands and still have enough cash to invest or expand. Suppose our ratio is 2:1. Suppose one company maintains ratio of 3:1, 4:1, then it is already, that means instead of keeping the funds in current asset, they could utilize it in investment purpose or expansion of business purpose, that is in fixed assets. So whether or not a specific ratio is satisfactory, it depends on the nature of the business and characteristics of current assets and liability. Generally, bank we are taking 1:1.33:1. In some cases, we are considering it 1:1 also. So let us understand the liquid ratio with help of this balance sheet. It is prepared in a vertical manner according to Company Act 2013. So here it is given Equity liability, shareholders fund, that is share capital, reserve and surplus. Non-current liabilities like long-term borrowing. Then current liability. Under current liability is given short-term borrowing, that is bank overdraft 3 lakhs. Then under trade creditor, one is bills payable 1 lakh, sundry creditor 50,000. Then other current liability means outstanding expenses 40,000. Then short-term provision for tax is 60,000. Net provision for dividend is 50,000. Total of balance sheet is, that is liability side is 23 lakh 50,000. Under asset, non-current asset, first property, plant and equipment 9 lakh, intangible asset 50,000. Then other non-current asset 1 lakh. Under current asset, under the head inventory or stock 5 lakh. Under trade receivable, bills receivable is 2 lakh and sundry debtor is 1 lakh 50,000. Then under cash and cash equivalent, cash in hand is 1 lakh, cash at bank is 2 lakh. Then other current assets, that is investment in security, that is short-term investment 1 lakh. Then prepaid expenses 50,000. The total of asset is also 23 lakh 50,000. So we have to prepare the current ratio. So for current ratio, the formula is current asset by current liabilities. So current ratio is current asset by current liabilities. So current assets, under current assets we will take inventory is 5 lakh, that is current asset, inventory 5 lakhs, then plus bills receivable 2 lakhs, sundry debtor 1 lakh 50,000, then cash in hand 2 lakh, cash in hand 1 lakh, cash at bank 2 lakh, investment security or short-term investment 1 lakh, then prepaid expenses 50,000. So total is 13 lakhs. Then under current liability, bank overdraft 3 lakhs plus bills payable 1 lakh, sundry debtor 50,000, outstanding expenses 40,000, then provision for tax 60,000, then provision for dividend 50,000. So total comes to 6 lakhs. So current asset is 13 lakhs and current liability is 6 lakh. So current ratio is more than 2:1. That is ideal ratio. Current ratio, here it is 13 lakhs divided by 6 lakhs. So it is 2.17:1. Then another ratio is liquid ratio or quick ratio. Under liquid ratio or quick ratio, we will not take into consideration the inventory and prepaid expenses because it will take longer period of time to convert into cash. So without loss of value, we cannot immediately sell those things. So 5,50,000 will deduct from 13 lakh, or we will not take into account that inventory is 5 lakhs, then outstanding expenses, prepaid expenses 50,000. So 5,50,000 will deduct. So it is 7,50,000. So liquid asset is 7,50,000 and current liability is 6 lakhs. So it is 1.25:1. So ideal ratio is 1:1. That means the current asset should equal to current liability. And another is absolute liquid ratio. We will calculate this ratio to know whether our business or the company is in a position to convert immediately into cash. In this ratio, we will take absolute assets. Absolute assets are cash in hand, cash at bank, and short-term investment security. Here it is cash in hand 1 lakh, cash at bank 2 lakh, so 3 lakh, then investment equity 1 lakh, 4 lakh. So absolute asset is 4 lakh and current liability is 6 lakhs. So ratio is 0.67:1. Ideal ratio is 0.50:1. So in the given problem, all the ideals or yardstick are satisfied. So in the next video, we will focus on solvency ratio. In solvency ratio, it is to measure the long-term solvency of a business, whether in the long term or long period the business is in a position to repay the debt of the outsiders. So under solvency ratio, we will calculate debt equity ratio, debt ratio, proprietary ratio, total asset to debt ratio, then interest coverage ratio. Thank you for watching this video. Then in the next video, we will focus on that solvency ratio.